A very good afternoon to all our participants. We thank you for joining us on this special panel discussion jointly presented by TaxSutra and Nextime on SEBI LODR regulation and its impact on related party transactions. Our first panelist for today is Mr. Sameet Gambhir. He is a senior corporate legal professional and company secretary with around 30 years of industry experience and is presently the Vice President, Corporate Law and Company Secretary of DCM Shriram Limited, New Delhi. Sameet is enlisted as one of the top in-house counsel by Forbes India in its Power List 2022. He is a member of the National Committee on Regulatory Affairs of CII and also a member of Corporate Affairs Committee of PhD CCI. He is also a member of the Board of Study of GD Goenka Law School. Our second panelist for today is Mr. Jaykumar Shah, who is a chartered accountant and has over 22 years of experience in building a robust finance function, developing a strong culture driven towards success, and advising clients across billion-dollar businesses. He has successfully managed major global projects across Europe and Asia Pacific in the past. He is currently the CFO of HDB Financial Services Limited, prior to which he was the Deputy Group CFO at L&T Finance and CFO at the Royal Bank of Scotland, India. Prior to joining the industry, Jaykumar has worked with PwC LLP in Mumbai, London, and Singapore in various capacities. Our third panelist for today is Mr. A.K. Vishwanathan, who is the Managing Director Tax at Nextime. He has multiple years of experience, including over 2 decades of experience at one of the Big Four, during which he has built and coached several high-performing teams across geographies. During his tenure at the firm, he led the risk advisory services and cyber security services in India and managed several key large accounts. He is currently playing a role of independent director and audit committee chair for companies in the financial services and pharma industry. He is a qualified chartered accountant, a certified internal auditor, and a certified public accountant. He is also a certified information systems auditor and is also qualified as a certified information systems security professional. Today's panel shall be moderated by Nextime's Deputy Managing Director, Transfer Pricing and International Tax, Mr. Maulik Doshi. Maulik leads the Global Tax, Transfer Pricing and International Tax Services at Nextime. With experience of nearly 2 decades and deep technical skills, he has been advising companies from a wide range of industries on transfer pricing and cross-border taxation-related matters. Maulik was recognized as a highly ranked practitioner by Euromoney's Transfer Pricing Expert Guides last year. Before I hand it over to Maulik, I would like to take the opportunity to apprise you all that in the last 10 minutes of the panel discussion, we will host a dedicated question and answer session. For this, you may post your queries in the Zoom chat box. With this, I now hand it over to Maulik.
Thank you, Tanaya. A warm welcome to everyone on this panel discussions on the recent amendments to the SEBI LODR regulations, mainly the impact on the related party transactions. I think the related party transactions have been a crux of a lot of controversies, right from income tax, from customs, from GST, and now even the company law or the SEBI aspects. So in that sense, the government across, irrespective of the branch and irrespective of the country, has this focus on to see what the multinationals or what companies are doing within its related party, within its group companies. And somewhere there is always a tendency to kind of capture and try and get the related party transactions more regulated and see more and more effect on that. So this is the kind of brief background in terms of how these related party transactions are getting into focus. In today's kind of session. In the first 15 minutes or so, we are going to take up certain changes that are made to the SEBI LODR regulations, and then mainly get into the discussions with the panel in terms of how this is implemented practically, what are the challenges being faced by the companies, and how companies should kind of look at these new disclosure requirements or new disclosure norms. So that's the overall background for and that's what we are going to do for next 40 minutes to an hour. So I mentioned about the rising instances. We've seen in the recent past a lot of newspaper articles and a lot of controversies surrounding the related party transactions, very large listed companies getting embroiled into it, and kind of the governance mechanism there getting questioned. So SEBI also in the past has kind of imposed strict financial penalties they give to the defaulters. The whole objective of amending this regulation was to kind of strengthen the regulatory norms and disclosure processes for related party transactions. I think a few years back, first time it came up that the companies now needs to start disclosing related party transactions on their website. There needs to be a pricing policy which is to be approved by shareholders, by board of directors, and there needs to be a proper disclosures in the annual report and the shareholders report that goes out. While SEBI and the company law are kind of looking at this, the related party transactions from a tax perspective were always the focus of the government right from the year 2000 when they introduced transfer pricing regulations under the Income Tax Act. And to that extent, India was a much late entrant in terms of introducing transfer pricing regulations. Some of the developed nations like US, Australia, Japan had similar kind of regulations maybe 30 or 40 years back than what India introduced. So in that sense, this is been not only in India, but at world at large being regarded as something which can be within the control of the promoter and within the control of the organization. And we can be used as a tool either to do a tax planning or some kind of a structuring or an arrangement. And therefore, there is a higher focus and higher kind of a need to regulate this kind of transactions. There are certain amendments which I'm going to take through, which are going to happen in a phased manner. Most of them have been effective from 1st of April 2022, but few amendments are going to get effect from 1st April 2023. So let's quickly in the next 10 minutes or so, 10-15 minutes, look at what kind of changes the LODR regulations has proposed or has brought in with respect to the related party transactions. So essentially, the first and the foremost is the definition itself of related party. Now, the related party was defined under Section 276 of the Companies Act. Essentially, any person and entity belonging to the corporate group, belonging to the promoter group and having a 20% shareholding in the listed entity was regarded as a related party as per the regulations prior to the amendment. Now, this concept of related party has gone a significant change with respect to from the amendment perspective, and what the LODR regulations have now brought in is a significant widening and expansion of the definition of related party. So earlier, only person or entity part of the promoter group having 20% shareholding in the listed entity was regarded as a related party. But now any person or any entity belonging to the promoter group, irrespective of their shareholding, once they are classified as promoter group as per the law, they would be regarded as a related party. So even if some promoter has a lower percentage, then itself that shareholder would be regarded as a related party as per the amended regulations. In addition to that, outside the promoter group, if there is any person who holds more than 20% shares or beneficial interest in the listed entity, that person, irrespective of whether he is a promoter, part of promoter group or not, will become a related party. And this threshold of 20% is proposed to be brought down to 10% from 1st of April 2023. So as on now, the threshold is 20%, but it will be brought down to 10% from 1st of April 2023. So as you see, there's a very wide and significant expansion to the definition of related party. And this is where possibly a lot of transactions and a lot of disclosure requirements would come in, because now pretty much a large number of parties would get covered, and therefore there will be enhanced documentation and enhanced disclosure requirement with respect to all of these parties. The second change is the list of related party transactions that would needs to be kind of reported, and that would require the approvals from audit committee, from the shareholders, from the board of directors. So basically, earlier the related party transaction was simplistically defined to mean if there is any transfer of resources or services or obligation between a listed entity and a related party. Mind you, the related party definition itself was a kind of restricted definition in that sense earlier. So if there is a transaction between a listed entity and the related party, irrespective of whether price was charged or not, this transaction was regarded as a related party transaction, and it needs to be kind of go through the approval process and the disclosure process. Now, post amendment, while the broad contours of the transaction has remained the same, in the sense it still covers transfer of resources, services, or obligations, but now between the even if it's between listed entity and any of its subsidiaries and the related party of the listed entity or any of its subsidiaries. So the definition has quite expanded again in terms of the transaction that gets covered. So if there is a transaction between listed entity and a related party of the subsidiary, then also the transaction gets covered. For example, if Mr. X as an individual holds say 25% in the subsidiary, where the listed entity holds say 50%, then the transaction between the listed entity and Mr. X, although they may not have directly any say between themselves, would get covered under this definition. And the second part is that if there is a transaction between a listed entity or any of its subsidiaries and any other person, where the purpose and the effect of the transaction is to benefit a related party of the listed entity or a related party of the subsidiary. So even if the transaction is with the third party, if the benefit of the transaction is going to a related party of the listed entity or the related party of a subsidiary of the listed entity, then that transaction also would now get covered within the expanded list of related party transactions. And this particular sense, the second part of the change is now effective from 1st of April 2023. So again, there is a deeming provision that comes into picture over here, that even though the transaction is with a third party, it actually can get covered within the definition of related party transaction, ultimately if the benefit is to either the listed entity or its subsidiaries. This is what kind of broadly I try to cover in form of an example, that where ABC is a listed entity and MNE is a related party of the listed entity, PQR is a subsidiary, and XYZ is a related party of PQR. Then earlier transaction between PQR and XYZ, which were not covered, but now from 1st of April 2022, transactions between PQR and XYZ also would be covered. In same way, transactions between ABC and INC, which is a completely unrelated party, if the transaction benefits either MNE or PQR, then it would get covered and from 1st of April 2023. So just explaining that in form of a illustration. The other part of the amendment deals with materiality thresholds for the related party transactions. Now, as per the earlier law, the materiality threshold was 10% of the annual consolidated turnover of the listed entity. Now, they have brought in an absolute number also, that if the value of the related party transaction is more than 10 billion or 10% of the annual consolidated turnover of the listed entity, whichever is lower, if it exceeds this threshold, it will be regarded as a material transaction. And this 10% of the annual consolidated turnover would be regarded as 5% if the transaction in question is royalty or use of brand. So in that case, if it exceeds 5% or 10 billion, it would be regarded as material as per the revised materiality thresholds as per the SEBI LODR regulations. So this is the scope expansion in terms of related parties, related party transactions, and the materiality thresholds. At the same time, there is certain, as per the LODR revised regulation, there is also an expansion in terms of the role of the audit committee. Obviously, earlier, all related party transactions required prior approval of the audit committee. Now, there are certain amendments to the regulations. The earlier position remains the same, that all RPTs definitely require a prior approval of our audit committee. Also, all subsequent material modifications to RPT also requires audit committee, and the audit committee actually has to list down and define what is material modification. So material modifications are not being defined under the law. it is the job of the audit committee to now define what is material modifications and disclose them as a part of the policy. And if there are subsequent material modifications to the related party transaction, it goes to the approval of the audit committee. And there are the transactions with respect to subsidiaries also would get captured depending on the thresholds, where aggregate value is more than 10% as per the consolidated turnover, then it gets captured from 1st April 2022, and the limit is further revised downward to more than 10% of the standalone turnover from 1st of April 2023. So the audit committee now will have to kind of look at all of these transactions, their material modifications, and see, kind of take them into account for giving the approvals to these transactions. The documentation requirement has also kind of enhanced, and just kind of giving an example of a financial transaction in terms of what kind of documentation or information would have to be placed before the approving authority. Apart from kind of looking at the intragroup financing from the funding entity, will have to justify the source of funding, whether the indebtedness was caused and what is the end use of the fund, but also talk about and justify why the proposed transaction is in the interest of the company. What is the relevant information? All the relevant information along will have to be provided along with the explanatory statement that is being sent to shareholders for the approval. And there is a focus on the intangible related intragroup transactions. Specifically, even the threshold level, we said, has been revised from 10% to 5% if there is a planned payment or a royalty payment. So there is a focus on the intragroup transactions relating to the intangibles. And from a disclosure requirement perspective also, now you need to disclose related party transactions in the specified formats every 6 months. You need to disclose that within 15 days from the publication of standalone financial statements and consolidated financial statements. And this 15 days time period is going to be on the date of publication from 1st of April 2023. So on the date of publication of standalone financial statements as well as consolidated financial statement, you need to disclose the related party transactions in a specified format. So just giving a very broad comparison in terms of what is requirement under the Companies Act and what is the requirement under the SEBI LODR regulation. The SEBI LODR regulations by and large only apply to listed companies, whereas the Companies Act, it applies to both listed and unlisted companies. So the Companies Act kind of distinguishes the transactions between two categories, which is basically if the transaction is not in the ordinary course of business or the transaction is not at arm's length, then there is a approval mechanism that goes through. But if the transactions that fall under ordinary course of business and they are at arm's length, then obviously there are no further approval required. The question is that who determines that the transactions are arm's length, and what kind of documentation, what kind of justification is being provided that the transactions are arm's length so that no further approvals can be required. Whereas with respect to listed entities, pretty much all transactions, and like I mentioned earlier, all material modifications of transactions will go through the audit committee approval of the audit committee of the listed entity. And if there are material transactions or material modifications, then the prior approval of shareholders will be required at the annual general meeting. And if the transactions are not material, then the audit committee approval will suffice and there is no requirement for a shareholders approval at the annual general meeting. So this is in kind of very nutshell, at a very high level, the changes made by the SEBI LODR regulations with respect to related party transactions. Essentially, like I mentioned, there's a widened scope of our related party transactions. There are still lack of guidance on certain key changes, definitions, ambiguity in terms of certain terms that are being provided. They are very ambiguous and left open to the companies to interpret it. Obviously, there will be a significant increase in terms of approvals required and therefore compliance burdens and therefore the cost. And kind of to deal with all of these challenges, we got an excellent panel today here with us. And I'm going to take up some of the questions with the panelists in terms of how they are looking at some of these challenges and what are the further practical challenges that they are facing. Essentially, the way I see it is that the most critical part would be the robust state of internal processes, how your internal processes, how robust they are to identify and disclose related party transactions, because the thing that you not want is to miss out any related party transactions. So your internal process has to be extremely robust to do that. You have to kind of look at how you are going to put out that the transaction is at arm's length. And we as a tax professionals struggle that for at least 2 decades and fighting with the tax authorities in India to prove how the transaction is arm's length. So the same thing would now come into picture in terms of defending the arm's length nature of the transactions. And obviously the documentation and the disclosure requirement to regulator as well as various stakeholders, that is going to be the key challenge. So with this, I'll kind of stop the presentation over here, and I want to get in my panelists. I'm really kind of fortunate to get such a panel with such a varied views. We have got someone who's kind of as an experience as a CFO running the kind of finance function and setting up the finance function. We have got an experienced person in terms of the legal part and the company secretarial part of it. And we have got AK Vishwanathan mainly from an audit committee perspective, in the sense how as an audit committee chair or a independent director, he would look at things when such things comes to you. So this is the background. I'm straightway diving into the questions with the panelists. For the audiences, like Tanaya mentioned, if there are any questions, you can put it in the question and answer window, and we'll take it up towards the end of this panel discussion. So first question, I want to put it up to Vish, to you, that how do you see this impact on the audit committee proceedings, especially in light of some of the recent media reports on the corporate governance related issues, and now the action taken by the market regulator on some of these corporates? So how do you see the impact of such kind of, where there is a controversy or there is a question being raised on the related party transaction, what impact it has on general audit committee meetings?
Okay, I'm going to go on stop the video, not to duck the question, but more to release some bandwidth. So let me do that first. Yeah, so thanks for the question, Maulik. I start with a complaint. My complaint against is all the crooks who make these regulators come up with these regulations. And the regulators somehow feel that it becomes audit committee's responsibility to almost do their job. But that's on a lighter side. Moving forward, I have been fortunate in terms of the board that I am part of, and part of the audit committee, as well as one in the chair of the audit committee. One is in the financial services industry, highly regulated. So we as an audit committee already have a good process in place. These new regulations is not adding too much of additional burden on us at this point of time. Many of the things that they are asking us to do, we are already doing. There's an omnibus approval. There's a list of transactions that we up front, and there's a reporting of it in every quarter. And there's something happening in between the quarter. There's a conversation that happens either in person or on circular voting process. So in terms of that, I don't think there is any additional bonus. We've also had conversations up to what is the process, what's the governance in place, what is the policy, does it need any tweak? And in some cases, the purpose also is being asked why we do that. And there's a fair amount of discussion about arm's length conversation, and we have established documentation. Previously, the documentation may not have been that strong, but we do now have documentation as well to establish how it's arm's length. So that's one part. The company, which is the other company where I am head of the audit committee, but it's not listed yet, now that it applies, we are actually had the discussion already in the previous audit committee to set up the processes, start with the policies. How do you identify related party transaction and arm's length, not at arm's length, the whole approval process. So that will be presented to the board in the next meeting in a couple of weeks' time. So the only challenge I have with this thing is there's so much of regulations coming at the organization and the audit and the board, audit committee and the board. Sometimes how much of time do we spend on being, I'm going to say, very possibly the regulators are not going to like this, my saying that. I'll say it anyway, because I did say to the regulator, one of the regulators, the board is not the agent of the regulators. They need to understand that. We are here to protect the shareholders' interest. I'm not disputing the purpose of the regulators or the regulations. but the regulations should not take away the purpose of the board and the audit committee. Theirs is a role of governance and ensuring the shareholders are fairly treated and the established strategies are being executed, process are followed, etc. More from a governance function. But the amount of onus being placed on the board and the audit committee is now taking so much of time. So that's a challenge we're having. That's a broader challenge, not only this regulation, but this regulation is also taken to a different level of scrutiny, and the size of the organizations.
Mm-hmm.
Right now, if you apply it to a non-listed entities also, then the size of the organizations comes into play. How many of these organizations can really afford to have an administration over this type?
Right.
And then I can look at a business opportunity for helping these organizations maintain this. But from a organization perspective, it's a huge overhead. I know organizations who are listed in the US delisting themselves because of one of the owners and the burden of the regulations. For example, Sarbanes-Oxley. I know many organizations caught off the market because the cost of ownership was becoming cost of regulatory compliance was becoming too large. So I know I give you a broader perspective, but in terms of this the regulation, I understand the need for it. There's no questions about it, but the mechanism of executing needs to be looked at because it's taking a life of its own. While I've been lucky dealing with the organization, one is already there. We're doing all the stuff the SEBI is asking us to do, possibly a minor tweak here and there, not major. The other one is having a solid board that looks at it closely. But I don't think if all the boards are equipped and have the wherewithal to do this to the level the SEBI is looking for. So
right.
that's my sort of broader comment.
Right, Vishnu. Jai, you want to kind of give your perspective in terms of whether this kind of an amendment were required, especially in light of some of the recent controversies, and did the SEBI take, in that sense, the right step in the right direction?
Thanks, Malik. Malik, the way I would put it is, it's surely created excitement, on what's happening in this space. I think disclosure and transparency are, always good. The challenge comes is, whether it's concise and it's helpful to the reader as well, right? Today, some of the people here would know when we used to read, financial statements years ago, or when we used to put up minutes, etc., they were concise and you could pick it up and you could read it and you could make sense out of it. Today, board minutes go into 60, 70 pages and, financial reports go into 200, 300 pages, right? In that, adding a lot more disclosure is a view which, the regulator has, will be very helpful. At the same time, how do you make it really concise is become critical. In our case, at the audit committee, we've been doing a lot of this already. However, what's happened is it's put a lot more onus on the audit committee, to look at every single line of the related party transaction. First it was only arm's length. Now it is making sure they own the fact that, it is not just good to be aware, but it is perfect. And that completely changes the landscape today, in the audit committee, when you go through every single line item and you say, this is why it's proper, this is why it's at arm's length. This is the reason why we're doing it. I mean, you're also having to do, in certain cases of borrowings, etc., parallel transactions to say, this is why it's good for me. So it's put a lot of onus on the audit committee, and I would say, challenging, because we meet, once a quarter or twice a quarter, and in a few hours that you've got to go through all your business, making it operational is a different ball game altogether. So I think that's one thing which I see is challenging. And I think it's going to be a balance for companies which are very high on corporate governance and which are getting there. And, as Mr. Vishwanathan said, getting there is going to be a journey. And, sometimes the regulator feels we've already given you 12 months, but 12 months sometimes may not be, enough for some. So that's one. And the second big big challenge that I see is, especially for subsidiaries related party transactions, where the parent is not involved, right, or not part of the transaction. That is where, it can get quite tricky because the parent then needs to approve it, right? Additional layer of governance, additional layer at the parent audit committee, etc. So it's put a lot of onus, and I think just now we're discussing it, but when we get to FY23 and some of the points that you spoke of, it's going to be quite onerous.
Right.
The CFO and the company secretary are going to be, I don't know, in quotes, gainfully employed for how much, I don't know. Yeah.
I always thought that we as tax professionals were dealing with the kind of ghost of related party transactions, but I think the circle and the target audience is increasing now.
Yeah.
There's a lot of questions. I think the crux of a lot of this is the expanded definition of related parties also. And there are a lot of questions from the audience that I see, and I have also questions. Samit, I wanted to get you in over here and just want to understand that how this amendment, which basically seeks to cover any individual or entity that belongs to the promoter group, regardless of the shareholding, how will you identify that? What kind of practical challenges you have in terms of this expanded definition of related party, especially without a shareholding threshold, covering each and every entity or individual belonging to the promoter group?
No, so I don't see there is much problem in this issue because in any case, we have to identify the promoters for a listed entity, and this is applicable only on the listed entity. So in any case, the promoters and the promoter groups are identified always in the listed entity. So irrespective of the fact whether they hold share or don't hold share, they should be the related party. And I fully agree with that. I really, this step is welcome. Because even if the promoter or promoter group person not holding a share, doesn't matter, he or she should be taken as a related party, or the entity should be taken as a related party. I think
Right.
that's not a big problem. The problem or the challenge people are facing is that how to keep track of all these, and even when there are small transactions, there are normal routine transactions, how do you control these transactions and how do you get every transaction approved?
Absolutely.
Because the list is increasing now. List is increasing because not only with the promoter group, but as you said, the person who is holding 20%, or maybe now it will become to 10% of more of the shareholding of the company, any person.
Right.
So that's where, but the good thing what they have done is that, the list you have to freeze at the end of the year, and then next year that list will be applicable. So that, during the year, if there is any person acquiring 10%, it will not be covered in that. So that's because of control perspective. So I think, according to this, there will be a list which used to be maybe 200 names will become 800, 900 names today, tomorrow. So that's how, it's difficult sometimes to control these transactions, and, you have to keep an entire list with the audit committee, all these transactions that will supposed to take place, particularly omnibus and all, when you have to take omnibus. So I think, so that's where a little bit challenges, which I can tell you that how we are controlling that, but I think including promoter without holding, that doesn't make any difference to me, frankly, so
Right.
It's not a big challenge.
So you're saying the identification is not a challenge, but obviously tracking all of those transactions with them and is one should focus on that, and one should create a system for that.
Yeah, we need to have a control mechanism in place. Like, for example, what we have done is now it's not a job of a CFO alone. It's not a job of a company secretary alone. So it's a job of a, it's basically complete, I would say, a task force has to be created in every company, wherein the person from the legal should be there, company secretary, CFO, and, at some moment the business heads are also required, other people, internal auditor also required, so that we can deliberate and make a complete process. For example, what we have done is we have made a, very simple thing to do is to control it with the PAN numbers, because we always have the PAN number of each and every promoter. We have the PAN number of shareholders. Now every shareholder is supposed to be a shareholder in the DMAT, unless and until it's very old shareholder who doesn't have a PAN number. So controlling by the PAN number seems to be the, the perfect idea to us. What we are trying to do is, and, in the system, in the accounting and all system, wherever there is any transaction which is going to happen, whether you're creating a vendor or you're creating a customer new, or wherever there is an existing one, so you put a flag on the PAN number of that person, and it will definitely come out, says that it's a related party. You have to make sure that first it gets approved. So this is how we have made a system. So I think yeah, it's a lot of exercise which we have to done. One has to done, but yeah, it's good for the governance. I think if it is a regulation, then one has to welcome that, and particularly as a compliance guy, I would say that it's okay.
That's great. Great, Samir. I think that's a really useful insight. Next is both to Samit and Jai. So Jai, maybe you can come in first. You would have kind of appeared before a lot of audit committees, provided a lot of data, etc. So what is the typical information or data points that they look at when they look at related party transactions? And what, in your view, what is the approach of the audit committee? I'll definitely come to Vish also later on to see. But I just wanted your perspective in terms of what do you provide to them and how do you approach the audit committee with respect to related party transactions?
So, Maulik, what we've done is fundamentally looked at it and said, if we are going to the audit committee, I'll give you simple examples, right? If we are coexisting in a particular property, right? What do we pay, to our parent or to one of the subsidiaries? What would we have paid otherwise, right? That is firstly to understand, saying, is it beneficial for us, right? So first is to make sure, for the company, it's not, going downhill. That's one. Secondly, in terms of transfer pricing, making sure how have we come up with, either the price or the cost, and making sure if we are charging today, and, I looked at examples where if somebody's taking up a few seats in a branch of ours, right, we go and cost it out to the minutest detail, however small the number is, it comes up to the CFO for approval, making sure all the detail is in there, that evidence is maintained. When we go up to the audit committee and we say, we've actually rented a particular space, that actual workings is attached and the evidence is there to make sure, that it's properly at arm's length.
Right.
The largest part that we do in our case is the borrowing side of it. And whenever we borrow from our parent, we look at it in a manner to make sure that, is it at proper market rates? So today, if I'm borrowing only for my parent, it becomes a question mark. Are you getting the funds cheap? Are you getting the funds more expensive? And we always try and make sure, we have a parallel borrowing from one of the other institutions. Then in case if we're providing certain services, we obviously try and, benchmark it to other services that either we procure or the parent procures or one of the other subsidiaries procure. And all of that, if it is fairly large, then we back it up with external, opinions and external supportings on what others in the industry are doing. So proper benchmarking studies, because it essentially, in a sense, whatever goes to the audit committee when explained at line item basis has to have full backup on how the management has got satisfied. And then we're, sharing the comfort that management has got to be able to sign the financials in the first instance with the audit committee and the board for them to then take further comfort.
That's absolutely clear, Jay. I think a lot of work there, but I think it does make the role of the audit committee much more easier and kind of much more, they get a lot of comfort from that if such kind of a documentation is being provided. Samit, you want to add on here, especially any other transactions? How do you look at, or what kind of data goes to the audit committee? Any other information points? Samit, you are on mute. You have to unmute yourself.
I think he's right. A lot of data is required, and definitely it's our duty that audit committee should have all the documentation to be able to approve the transaction, because ultimately it's a responsibility of audit committee to see that the transaction is in the interest of the company. It's not detrimental to the company, at least, So I think the backup paper are very, very important, and we make sure that, either it's a transfer pricing related, calculation, or it's basically market price, or otherwise, any other calculation, and, comparative quotes, etc. So, all kind of a backup documents we generally prepare. And audit committee now, they have increased one or two more things to be seen by in the column actually to be placed before audit committee. So I think audit committee also has to see that, particularly in the case of, we increase in the case of loans or advances, or in the case of investment, etc. They have to really see that, the funds sources of the funds, and then they have to see that whether this ultimate beneficiary, who is going to be the ultimate beneficiary of this thing, and why it is in the interest of the company. So this thing was not there because earlier, I think we used to only give the nature of transaction and maybe, in the interest of the company, but now we have to disclose the ultimate beneficiary, sources of the funds, whether it's the borrowed funds, internal funds. So I think I feel it's a good step actually. Audit committee should be fully informed before they actually approve a transaction, because ultimately what happens is once a transaction is approved, then, the entire this goes to the audit committee that they have approved it. So ultimately, if they don't approve, it's a problem for the organization. So whatever best documents we should provide so that they can easily take a call. Yes, it is to be approved. I think that's very important. Yeah.
Right. So I wanted to come in here to you, Vish, being a part of audit committee and independent director. So I have done transfer pricing for 20 years. One thing I have learned is that arm's length price is always a myth. You'll never reach in reality an arm's length price. So Vish, how do you look at some of these related party transactions when it comes to the audit committee, especially some of them may be unique, some of them may be very complex, certain monopolistic transactions which very difficult to identify comparables. So how do you look at some of these areas when such kind of information, such transactions come to the audit committee, and what are the things that you would want to see in terms of before the audit committee actually approves that?
So one of the financial services industry where I'm involved in, the complexities come in one of the type of services we provide, which is sort of the BPO type of operation, where the pricing, why do you price it this way? Though it's cost plus, if it's cost plus 3%, why is it 3%, not 4% or 2% or whatever it is, vice versa. So there we are obviously the way we are using it is get an independent study of the pricing that's available for similar services. The challenge is similar services. How do you compare? I mean, how similar, right? And I don't think it's an easy answer for that. And now you hold audit committees responsible for approval. I just want to slightly digress. The fact that you are asking for approval of transactions. Now the question is the audit or the board a governing body or a management body? Because the minute you are coming to transactional level approvals, I have a question about it. What is the regulator's intent there? Just leave the question open, because I need people need to understand that, because there's a very thin line we are crossing here from governance to management function. Coming back to the thing, the other area is I think specific thing on branding, right? Obviously, right. Some organizations have spent years in getting a branding. The name brand holds something. Then the question about how much the subsidiary or the parents or the related parties in this case gets the benefit of the branding. There again, we have taken independent study, though it not come specifically from an RPT transaction for. Interestingly, it's a GST transaction that prompted that study, because the GST authorities are asking, hey, how did you price this thing? Is the tax calculation right and all that? But it's coming useful for our RPT transaction, simply because then we are able to establish an independent study and then figure out is it in an arm's length or not, or is it beneficial or not, or etc. There again, the questions is where do you drop the line between the regulator and the business owners?
Right.
The business call is being made. Now, every business call has to be questioned by the intent. I have no problem, but the transaction itself I have a problem, right? So, and that's a struggle we have, right? The establishing the amount of then establishment of thing, and all this for again. Sorry, folks, I'm crapping on the regulations in some of the cases simply because a few crooks, they're already out of the gate. Now we are the 95% or 90% of the honest people are paying the price for the 10% or the 5% of the crooks who are already through the gate and possibly preparing more schemes to scheme the system. Now the people who are paying the price is the 95% of the people who are trying to bear the burden of some of the minuteness of the thing. See, even the regulators have to look at more at the governance level. What do they want? What do they want to the shareholders? Public listed company. So I'm in a good position personally. In one of the organizations, the transactions are not very complicated except for the BPO operation and the branding pricing. And that's not the case. That may not be the case in the other way. That's so early days for me, taken over recently, but there's already a fair amount of conversation I and the board are having to establish these norms. And I think we would have done that irrespective of SEBI regulations or not, because the governance matters. That's what I'm trying to. As an audit committee and the board, governance is the key piece. So then our responsibility to make sure the process are in place and the policies are in place so that we can execute on the governance model to make sure and ask the management make the management accountable for showing us that all these policies are in place and they're being followed. And then the mechanism of level one, I mean, in the financial services, we do that level 1, level 2, level 3. For example, policies are set, the operations are done by the management. There's a second level controls who are saying, look at the compliance, and the third level internal audit that's make sure that all the things are met. Right? The same method if you use for every industry. And I think that's what we are doing. That's what my experience in how we're going to address the requirements. So when the regulator comes and says, listen, what did you discharge your duties as audit committee in this relation to this? We should be able to provide them. Yes, this is how we have done that. We have set up the governance. We have set up the policies. We have set the identification mechanisms, the reporting mechanisms, reporting to the management, reporting to the board, reporting to the regulators, whatever. So all those things are being followed. And we also have a compliance function, which is looking at that what the management is doing is in compliance with the regulations. And the third line, internal audit, also looking at it, saying, making sure that all these three pieces are taken care of. So that's the way we are looking at it. And huge cost of compliance, And it's for us, for me personally, it's a huge distraction from a lot of other things we need to do as audit committee.
Right. No, absolutely. I think Vish, you made a very valid point, and I want to pick up Jay on that in terms of management function versus the governance role. But before I come to that, Jay, there is a question from the audience related to this. So I want to take Vish's view on that. So Vish, one question is very specifically on how do you ensure that the completeness in terms of identification of related parties there? I think that's where Samit mentioned about various control mechanisms. But as an audit committee, how do you see that the completeness of identified related party transactions are there with you?
Let me be very specific from the financial service industry perspective, because the other industries thing is very new, not listed. We are still putting the things in place. Going back to Summit, I think the PAN number is where we are running with, because our business that cannot do without that. So I know from a customer perspective, it's straightforward. Even from the vendor perspective, I don't think we can do business today without PAN number. Right. I know every transaction, there are always going to be some slippages. Somewhere I pay 10,000 rupees to somebody and I've not taken the PAN number, so be it. I know every transaction is the requirement of the regulator, but we need to go beyond that, at least from a perspective. So PAN number becomes the critical. And now this conversation almost happened, I would say 1.5 years ago, 2 years ago, in the audit committee, saying, hey, listen, how do you establish related party? Much before the regulations came out and asked us to do things. How do you establish the related party? How do I know your complete list of related parties? And the answer was, we had done a complete exercise of all the payments and the payments made, whether it's for our customers' disbursements or from vendor payments. PAN number, we had looked at the PAN number and established the link, because it's not only the promoters, but also the key management personnel, because of ESOP or whatever, it has become shareholders and all that. So we have done an extensive exercise to establish that list, and so that we get the comfort from that exercise we have done, and continue to, it's become a part of the whole identification process.
Right, absolutely. Jay, I'm coming to you now with that thought process, which also mentioned in terms of the management role, the governance role. Do you think the role of audit committee is becoming more operational?
I think so. I mean, what has happened, at least over the last, if you ask me, 3 or 4 quarters only, right, is we're taking a lot more detail to the audit committee, a lot more, right? I don't think in terms of the final output, anything has changed, right, in terms of what we need to arrive at. But the acclimatization, I would say, is something which will be a journey now, right? Because suddenly you were showing it at a level, now you're showing everything granular. Now all that granular that you take to the audit committee now needs to get used to it. And we were discussing it with our auditors when we did the year-end closure. The amount of things that everybody's placing with the audit committee, it's just taking more time because they've got to get used to the operational aspects that we place. Obviously, since it's placed and it's there as a part of the pre-read, everybody needs to read it, understand it, and then come prepared to the meeting for a discussion. As management, part of it is easy for me because I've prepared it, right? But that side of it has become more operational. The other thing is, as you put down some April 22 and some April 23, right? A lot of it is going to flow over the next, I would say, 12 months in terms of us putting out a lot more detail. I think some auditors committees may be faster where it already exists. For some, it will take them time over 12 months to get used to it.
Right.
And then the time will again, balance out, because the first time up, you've got to understand everything. Then transactions will all be similar. So you get similar backup, you'll get similar evidence year after year. But I think the first year is going to be a fairly large transition, most as management tries to comply and put out as much detail as possible. That's at least where I think it's going. I'm not sure about others, but that's how I think.
Right. Samit, there's one aspect that we addressed, and I also mentioned earlier, that transactions where the listed entity is not a party, says between the subsidiary and the related party. Do you think there are challenges and that those transactions also require audit committee approval, subject to obviously certain monetary thresholds that we discussed? So do you think there are challenges in implementing this kind of stuff also, because sometimes your subsidiary may be in some sense independence from an operational perspective?
No, that I agree. Yes, I think regulator has to think again on these issues, particularly when you are saying that listed entity is not a party. But you're right. Actually, there are many groups, and those who have subsidiaries, hundreds of subsidiaries in various countries. Actually, so that is really a big problem. Now, to tell me, today it's basically should not exceed consolidated turnover of my. After a year, it will become that consolidated or maybe standalone turnover of my subsidiary. So that's where, there are 2-3 problems what we are facing. One is that, for example, my subsidiary is very small and, the turnover is very small. And then that subsidiary is doing some transaction with one of my related party. What happens is, for 1,000 rupees or, if 100 rupees or maybe 1 lakh rupees, you have to go to the audit committee, because chances are that subsidiary turnover could be very small also.
Absolutely.
At the same time, it's a big subsidiary, very big subsidiary. And, one of my subsidiaries sitting in France and, one of my subsidiaries sitting in, for example, US and, 100 subsidiaries in different countries. Now they are doing business with each other, because in conglomerate organization and big organization, what happens is one is supplying to the other, and then captive supply and other things. Now, all these transactions come to my audit committee of listed entity. That is something which is making a lot of problem to us. That is something, and then they say that we are governed by our own laws. Why do we have to give it to you now? Who are you to govern it? We are ultimately, you are maybe you are holding 60% or 70% in our company, but we are ultimately governed by our board, our independent directors, our regulation, our laws. So, and then getting data from them, making them as a part of entire process, it's something which is giving problem. And the other thing is that in terms of small subsidiaries, they have only said that 10%. For example, they should have some kind of a absolute
monetary threshold
figure also,
absolute monetary, absolute number.
Absolutely. So that at least, up to some extent, only amount increasing that particular amount will go to the audit committee or something like that. So yes, there are operational issue in that issue, and that, the regulator has to think once again, I think, on these issues, maybe.
Absolutely. And you mentioned about international, kind of brought in a perspective. I'm also wondering in a situation which is kind of a diversified group or diversified business. Right? Very different businesses. One may be cement, maybe shipping. And how do you kind of correlate, and the shipping business transaction comes to the audit committee?
Different company, yeah.
It's very difficult. I can really anticipate. I'm not sure what was the thought process of the regulator.
I mean, they have no expertise on that kind of a business particularly.
Absolutely, absolutely. Wish you have a perspective over here. How would you look at such kind of a scenario?
You have to switch off your video first.
There is never a lack of perspective from my end, Maulik. You know that enough.
Right.
Yeah. So there's no end for my perspective. So I will. So I'll. It's that comment about the role of the governance and role of the management, the board governance, and the operational aspects of the management. And a similar line has to be drawn of the thing, because the regulators cannot get into the normal day-to-day business of the organization. There's something. Let me put it there. What's the purpose of all these regulations? Is because somebody did something bad, and it impacted. Somebody impacted. Now, the reason I go back to the point is this: you need to find the solution to the problem rather than creating more problems. Now, you are venturing as a regulator into areas, like exactly said. Now, two of my subsidiaries do a transaction. Now, how do I even establish the beneficial arm's length or out of the benefit that they borrowed money from me and give? It becomes very difficult to establish those things. Now, because you put it as a regulation or a law, and the audit committee has to approve, how do they approve? How do they even establish that are transactions? And they'll give a simple example. The Big Four I used to work for were anal about being, if somebody is regulating something, they will say about 5 steps about that we need to do. So though I was not an audit partner, I used to have to give all my shareholdings of my son and my daughter, my son-in-law, and it's just really based on the Companies Act. I told them, listen, guys, you want me to sack me as a partner, you'll have to sack me, because my son will not tell me what his financial holdings are. I cannot ask him. Right? So now take it to a corporate situation. If you're shipping business in a foreign country, the CEO said, why would I want to give you business to you, information to you? The type of information you're asking, especially if you're not directly a related party. I've got a port connection to you. They'll say, listen, guys, I don't have time for you. You've got regulations, you deal with it. I have no time for you. Now, where does it leave us? Is the company, Indian company, or the board?
Absolutely.
That's my perspective. Yeah, it just it's easy to sit in the chair. I mean, these things have to be dealt with by business people who's working with the regulators. I know this committee isn't all found, but at the end of the day, these regulations seem to be more coming from armchair people looking at these sort of things, because there's no dispute on the intent. I have zero intent, because yes, this is required, absolutely zero. So I'm not saying that. But the level of details the regulator is going into, then what's happening is the people they are trying to capture are finding different ways, because you said ask me to turn right, I've turned left. Classic example is the surveillance officer example. What is the C statement has to make? The CEO, CFO has to certify that they are in charge, they are responsible for financial controls or the controls, internal controls. Boss, why would you have to say something static? Because the CEO of the Enron went and said, listen, I was not aware that is my responsibility. I left it to my CFO.
Right.
To the Congress. And the Congress passed legislation saying the CFO has to explicitly say that. Now, if you pass regulations like that, the crooks are going to take advantage of what you're trying to regulate and do something different because you're not on the regulation. You need to have a broader sense of how you do this so that hold them responsible, hold them. I know I'm sort of keep coming to that, but the point is, at what level do you create the corporate governance intent, and what level you stop the regulation? Because this at this point of time too detailed may not put orders on us to do this, but it may not serve the purpose you're trying to go at, because there are people who are trying to beat the system. Is going to use the same details to do, okay, you've not said this so many words, I'm going to do it different.
Understood. I think that's an interesting perspective, Vish. Jay, I read some kind of in the regulations that justification as to why related party transaction is the interest of listed entity that needs to be provided as a part of the documentation to the audit committee. I thought this was a very loaded and very dangerous statement in terms of keeping it very open, justification as to why RPT is the interest of related party. Any thoughts on that in terms of how would you go about looking at that, and how would you convince the audit committee on that?
It's an interesting one, to be honest, Maulik. And today you do so many transactions, as Samit was saying, across the group many a times. And it's part of BAU, because when you go to source something, you look at what's best for you and you look at what's available, etc. Sometimes you're also looking at a larger size where what you have available. Now, I think it's just the nature of the beast where the regulation has changed, and for every single step you take, you have to prove that you've taken it in the right direction.
Right direction, absolutely.
It's like you're scaring the baby before the baby walks. Saying, make sure you don't fall. Make sure you don't fall. Repeat it so many times, the baby says, do you really want me to walk? Right? And somehow, it'll become a deterrent, saying, if it's within my group, I don't want to do transactions. Let me go outside first. Right? It makes it easier. It's like Vishnath was saying, right? If you're a Deloitte partner or PwC partner, you say, let me not buy shares, let me not invest in something else because I have far too much regulation. Now, if you have to do a related party transaction, you'll think twice to say, do I really need to do it? Only if I need to do it, and if it's of some size and value, will I bother? Because the amount I have to explain will cost me more than the actual benefit I might get in terms of the whole admin around it and proving to every person that this was beneficial, right? So I think at some point in time, hopefully the regulators and everybody understands, but in the short to medium term, it's going to be very painful, right? Because everything we do, we have to now explain why is it good for me. And if you ask me if I'm taking, say, a place in Mumbai or in, Bhopal or something, and, my parent has a property and I need, 200 square foot and I'm going to take 200 square foot there, I have to actually scout the whole market and compare now and say, I'm getting it the same price or 1 rupee less, right? I might as well just go pick up 200 square foot somewhere else, right? So it's losing its synergies. It's not understanding that why is the corporate made for.
1 second there,
right?
Jay, if you can interrupt you there for a second. That is, you said you get 1 rupee less after scouting the market, assuming that's a related, because it's a related party in this case, but assuming it's a corporation, the same question will come to them, why did you give one person 1 rupee less? Because the market would give it the...
Exactly.
Where do you draw a line?
Exactly.
And that's the challenge, that it's going to be making it very difficult to do related party transaction. Let me put it that way, right? You practically will have to go and say, I'm doing a transaction here. I have a parallel transaction as well. I'm doing it with my, related party and with an external party, and both are the same. And, it's not a perfect world.
Another example. I'll give you another example, folks, where I'll give you, without naming names here. It's not even a related party transaction, but imagine the complication would have been a related party transaction. Now, we were trying to do a deal of saying buying loan book of a particular product to just expand our business. Now, the numbers mentioned there looked too small for me for ticket sizes. Hey, listen, if you're really going to expand, why would you? And then the answer to that was a good answer, saying that, hey, listen, this business, the players are not that big, right? If I put a minimum ticket size to be this, there'll be hardly any player I can buy the book from. Now, in those cases, see, the reason of the context I'm bringing to is the size sometimes gives you the benefit. The concept is called a market maker. There's some people are market maker who get the benefit of doing certain things certain way, whether it's related party or otherwise. So if I don't leverage my position in the market to get a better pricing, but the other person will not do it because I can't do the deal with you because I'm a related party, because people will look at it as suspicious. Now, a normal business transaction goes through a different cycle because there's no context set in the regulations. It's a very clear thing. There's a concept called market makers. There are some people who are market makers. They will get a different pricing in the market just with their name because of the size or whatever that is, the context. There has to be context even to related party transaction. So now, like Jay said, I walk away from transaction because too onerous for me to prove it. So what do I say to the audit company? Say, because I'm a market maker, I got a different pricing?
Absolutely. Samit, one question slightly closer to my heart. In the transfer pricing, in the income tax context, the arm's length price is defined. There are methods that are defined under the income tax law. There's a documentation requirement, which is pretty much aligned to the global documentation, internationally kind of recognized documentation requirement. Do you think there is a synergy in terms of using those concepts? And do you think the arm's length pricing perspective or concepts that we use in income tax or for that matter customs or GST that would really come into picture here when you are kind of looking at the transaction before the audit committee, or it would be kind of a completely different approach?
See, the first and the foremost thing is SEBI doesn't talk about anything on the arm's length. It's only in the Companies Act, which says that if the transaction is not on arm's length and ordinary course, then it should be approved by the board, otherwise audit committee. So SEBI is only, and SEBI's scope of transaction is, each and every transaction of RPT comes into the scope of SEBI. Right. And it only says that prior approval of audit committee, that's all. It doesn't say anything, whether it should be transfer price, it should be on arm's length or ordinary course. So it's basically entirely on the judgment of audit committee or maybe the prudence of audit committee that they say. So therefore, you'll have to justify to the audit committee saying that this is something which is a transaction in the interest of the company, or we need this transaction, or there is a requirement of this transaction, whatever way it is. So, but since we have to comply with the Companies Act also, so Companies Act is basically focusing on certain transaction, not each and every transaction. So the moment I'm talking about sale, purchase, or a service transaction, etc., which are covered under the Companies Act, of course, the transfer pricing, as per you were saying, the global standard should be good enough, I think, and that is the criteria one should take according to me, and that's a good enough. But other than those transactions which are not covered under the Companies Act, law doesn't say that you have to prove the arms length exactly. So right. That's where you not necessarily required to give all this kind of proof, but you should have your internal evidences or anything else also. But yes, more or less, people are using all these global standards of transfer pricing. I still remember, when it was started, in one of the big transaction in one of my previous organization, the audit committees. But see, the audit committee is independent directors, so basically they need to be updated on a lot of other things also. So in that transaction, there were 3 audit committee. They did not get themselves satisfied that this transaction is in the interest of the company or not, whether we should approve it or not approve, whether it's arm's length or not arm's length kind of a thing. Then finally we hired one consultant, because they have a right to hire consultant also now, independent. Right. And then an advisory company was hired. They, the partner came, he gave entire presentation, entire global system, this guideline, that guideline, and then finally, they were on a conclusion that okay, now we can approve it. So that's the kind of governance I have seen in many companies also. So I think more or less this global standard is actually working fine.
Absolutely. Okay, great. Now I'll come to the audience questions. There are kind of 3 or 4 of them. We can quickly take. Most of the audience questions got answered in our panel discussions, but I think 3 or 4 of them are separate. There's one which talks about generally the group purchase agreement with third parties, basically to avail volume discounts for all group companies, right? To avail the synergies of group purchases, etc. Now, will this transaction also get covered under the definition of related party transaction from 1st April 23 on account of the fact that it is benefit the related party? And how would you look at such kind of transactions? Samit, Jai, anyone wants to come in over here?
So one thing we've been doing genuinely applies to most large groups, right, is to try and see if we can sign individual agreements, right? Okay. Where you agree on pricing, but if you can, you try and do. Otherwise, you clearly document as much as you can to say why it's beneficial, why, the related party transaction which you enter into, along with your parent in the group, you're no worse off or no better off, and compared to the market also you're no worse off but only better off. Just becomes very onerous. Sometimes in a very large contract you've just got to do the documentation because there are larger benefits. Otherwise, try and break up the contract and do it at individual entity level.
Absolutely. That's great. There's another question, maybe all 3 of you can look at this. Is it legally valid for the audit committee to ratify or disown certain transactions if they are not satisfied? And have you, in your experience, come across such kind of an experience where audit committee has not really approved or disowned a particular transaction? Vish, maybe you want to start first?
So fortunately, I have not the opportunity to, sometimes the disown doesn't come into the play, right? Because the approval is prior approval is required, right? It's not a question of disowning. If you're not approved prior, at this point, I've not had fortunately, no reason to disapprove anything. But let me say that I think the independent directors will do that. If, for example, I think Sumit made that point that 3 audit committees went through the same transaction to make sure that they're all comfortable with that. They even went to the extent of getting external help to establish that. That's what we'll do. And I think if somebody does it, all the thing, the management also start thinking, hey, listen, why is it taking long? Because are we doing the right thing here? Personally, I've not had to disapprove anything, but there are times when we have a lot of questions. A lot of discussion happens around it. For example, this specific question that was asked about group transactions. Yeah, we had a discussion around one of those group transactions where we do technology spend that's substantial as a group, and there's a benefit of doing it as a group. Then the question is, how do we establish the arm's length, etc., and then the documentation behind it. But there's a fair amount of conversation that happens. And in my case specifically, the question is how we've dealt with this. As an independent director, I get enough information, ask questions, get enough information, and approve it only if I'm up. So far, I've not had the thing where any independent director said no. But I'm also had the opportunity that all the independent directors have asked their independent questions and got themselves comfortable before they approved it.
Right.
And the management has also been very good in providing that information. So at this point of time, there's no opportunity. There's no reason to disapprove anything. But this one doesn't happen because the minute you're in the board meeting and you're signed off on the minutes, you've approved it. Even if you're not there, if you're not specifically stated this is not to my liking, then you are basically presumed to approve the transaction.
So, Jai, your thought process,
In summary, you've just got to convince or get convinced.
Okay. That's true.
I don't think it moves ahead. Like, I mean, if the audit committee doesn't agree, they don't agree. So
the transaction,
I think keeping aside the legal rights, and I'm not a lawyer, so I take benefit of that. I think the audit committee, in consensus says we don't agree. As Samit said, you'll have to keep presenting back if you want to go back and back. But if they don't sign off, they don't approve. And if they don't approve, you can't do it. If you do it without their approval, it's you putting yourself at risk.
Understand. Yeah. Understand. Absolutely. Samit, any other thoughts? I think broadly the same. This one question.
I think, the only thing is that either you have to drop it or you have to modify it according to, requirements, or otherwise you have to, as I told you that, hire somebody to explain the justifications, etc. But I think, yes, audit committee has to approve it. And the ratification also, somebody asked for the ratification also. I think it's not legally allowed basically because it is, as Sir rightly said, it's prior approval which is required. However, I've seen in some small cases, for example, genuinely audit committee or company missed the transaction and, genuinely they have entered into a transaction, but the size of the transaction is not very material, or even if it is a material, I don't know. So what option do they have? It's better to take it to the next audit committee, tell them ki bhaiya galti ho gaya, and we have to do it, and then let's see what happens tomorrow. But the point here is you don't have to hide it. By chance something has happened, then you have to take it to the other company. But it's not legally allowed, frankly.
Absolutely. I think we are running out of time, so I think really exciting and really enriching session that we had. I kind of really thankful to all the panelists, Jai, Samit, and Vish. We really got superb insights in terms of more practical knowledge in terms of how one should approach the amended regulations and the related party transactions. I'm sure our audience would be really greatly benefited with this. So thank you so much for being a part of this panel. Tanaya, maybe closing your side and we can close it.
Yes. I think Maulik at Tax Sutra, it's always a great pleasure to jointly conduct several webinars with next time. And I think this time I would especially like to extend my gratitude to the panelists, Samit, Jaykumar, and Vishwanathan sir, for taking out their valuable time and imparting these key insights and wisdom with all the participants. And Maulik, as always, you moderated today's session with complete finesse. So many thanks to you as well. And I think I would also like to extend my gratitude to the Next Time team, Jitin and Amira, for helping us to put the session together. So with this, we end today's session, and I look forward to hosting and you all for another session on another topic. So thank you so much to everyone, and thank you.
Thank you so much.
Thanks, everybody.
Thank you. Thank you. It was
Thank you.
nice meeting
Pleasure.
you,
Thank you.
Maulik and Jay and Sir.
Absolute pleasure. Thank you.
Pleasure. Thank you so much.
Pleasure. Thank you. Bye.
Bye.